Shopify stock lost over 70% in its market cap during the last 1 year, which translates into $118 billion lost in shareholder wealth. In this video, let's talk about its stock price, a huge destruction in its shareholder wealth, reasons why it might have gone down, what could be its future in 2023, is it the right time to buy, and at the end, my perspective about it. Now for those who are new to this channel, my name is Sunny and I make content that help a common man financially. So let's dive into today's topic. Shopify lost $118 billion in market cap. Please like, share and subscribe as that will help boost the YouTube algorithm for my channel, which of course will be highly appreciated. Ever since its IPO in 2015, Shopify stock has done exceptionally good except for recent times when the central banks are implementing money tightening. Today on the day of recording, it is trading at $52.47 Canadian, but looking at its 6-month performance, it is up almost 30%. When you look at its 1-year performance, it is down over 70% from its peak of about $190 Canadian to where it is now. In spite of all this destruction in shareholder wealth, Shopify stock is up about 1400% since its IPO, which is not bad considering the nature of stock market these days. No doubt, Shopify recently has been one of the best performing stocks on TSX. Therefore, its recent 70% plunge has single-handedly dragged the Canadian stock market into red this year. This Canadian e-commerce software giant has lost $118 billion in market value in 2022, or an equivalent of 160 billion Canadian dollars. Consequently, TSX Composite Index fell by 2% in Canadian dollars or 978 points. We all remember other two Canadian stocks, Nortel Network in 2001 and Research in Motion in 2008, that have brought the index down by over 300 points. Still, Canadian index has outperformed S&P 500 this year by more than 10%. There are multiple reasons at play behind Shopify's $118 billion destruction in shareholder wealth in 1 year. Bank of Canada and the Fed tightening the money supply to lower record high inflation is a major contributor. Economically, when bank rates go up, the prices of assets like real estate, stock, etc. usually go down. This is exactly what is going on with Shopify stock these days. Being a high growth stock, its valuation is more dependent upon its future exponential growth that investors were expecting. The current economic environment popped the bubble, thus the stock crashed. The stock price of a stock reflects its earning potential in the future but discounted to the present date. No doubt, technology and high growth stocks have come down a lot while the bank rates are rising. Experts believe holding them for long term has always been a better and more profitable option if you do your homework right. Nobody has a crystal ball who can predict where Shopify stock will be in the future. I believe in 2023, the central banks will keep on increasing rates until inflation is in check. Therefore, Shopify stock might go down more. Right now, all e-commerce stocks like Amazon, Shopify, Alibaba, etc. are massively down. Surely, Shopify was trading at a lofty valuation of over 45 times its sales as investors were pricing it based on its future prospects. With experts talking about possible recession next year, consumer spending is bound to go down. That will reduce inflation as well. Apart from Shopify, there are other big e-commerce stocks worth considering like Amazon. Even though it has gone down 50% from its highs, but having consistent cash flows is a positive for the stock. A stock being down 70% from its historic highs should not be the sole factor while deciding whether to buy or sell a particular stock. I have always emphasized on developing an investor's mindset where a plan should be in place before you buy any asset. Now talking about Shopify, I like their business model and the dominant market position they have, but don't like their valuation. I completely understand it is a growth stock, but being an investor, I try to incorporate a safety buffer while arriving at its valuation. Therefore, given the economic environment, I would wait till the rate hikes are gone, and I believe it might go little bit more down. This does not mean it is a bad company. Rather, the stock price is adjusting to the economic reality of these days. But that is me. I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor, so please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.